Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. So Kindly MD, ticker NAKA for Nakamoto, is down 52% today. We've seen this stock price go down quite a lot in the last few days, so we want to talk about why. Why did this happen? Well, the answer is pure uncut share supply, because last Friday, the company filed an S3 that registered about 590 million pipe shares for resale. No lockups, no mercy. So that means the share float has mushroomed from a pre-merger 7.6 million shares to roughly 353 million. So the order book looked like a garden hose trying to funnel Niagara Falls. And then you factor in the brand new options that started trading on the 11th, dealers shorting stock to hedge those calls, plus a convertible note lurking with a reset trigger at $2 that could mint 100 million extra shares, and you get a perfect physics lesson here. Add mass, you lose altitude. But the key takeaway is that this faceplant is just math and not necessarily sentiment. Could this have an effect on sentiment? Absolutely it could. But I do not believe it was the causal factor. Think back to high school economics, kids. When the supply overwhelms the demand by 40 plus times, the price behaves like gravity wins every argument. Let's go over it. So it's 2 p.m. right now on Monday. We're at about a $1.31 price. This is varying in the $1.30 range. So it could close around here. We'll see, but that is a significant drop off. So that is a $1.47 splat, or minus 52%, give or take a few percentage points, since Friday's close. The kind of number that makes your brokerage app ask if you're feeling lucky before you refresh. Now you check the volume, 83 million shares, about 52 times the sleepy 30-day average of 1.6 million. That's like your local coffee shop hosting the Super Bowl, okay? The order book is trying to serve lattes while the stadium crowd is screaming for exit liquidity. But remember, the 52-week low for Kindly MD sits down around 65 cents, so today's nosedive has not even come close to setting a new record. Which, maybe the translation is this roller coaster still has plenty of track below us. We're gonna see this test some serious MNAV levels, folks. Now you might be asking, Adam, what on earth is a pipe and why did it smash our share count? Well, time to unpack the four-letter culprits behind Monday's massacre. PIPE, P-I-P-E, is private investment in public equity. So think of PIPE as Wall Street's late-night drive-thru. A hungry public company pulls up, says one bucket of cash, holds the SEC delays, and a syndicate of funds hands over money in exchange for freshly printed shares, which are usually at a discount. There's no roadshow, no retail hoopla, just signatures, wire transfers, and a Form D filing. Fast, cheap, and lethal to the cap table if you are on the wrong side of the counter. For NAKA, the drive-thru order went through on August 14th, 2025, which was 341.4 million common shares priced at $1.12 each, which is almost a 90% haircut to the pre-deal hype levels. And the total pipe proceeds were about $510 to $540 million, including warrants. There's 133.1 million pre-funded warrants at a token 0.001 exercise price, which is basically IOUs that convert into common stock whenever the holder clicks redeem. Around 700,000 of these are already flipped, so the blender is running. So the grand total registered for the resale in the S3 filed for September 12th, 590.3 million shares. No contractual lockup, no staged selling plan, just a green light that says dump at will. That is how we leapt from a quaint 7.6 million shares outstanding before the merger to a burly 353 million public float, which is about a 46x fold expansion in the share count. Picture a pufferfish inflating in slow motion, except the spikes are all pointed at the existing shareholders. So why do companies sign these deals? Well, because capital is oxygen and pipe investors bring scuba tanks when the bond market will not. So why do pipe funds love them? Well, they get deep discount stock, plus warrants, freedom to hedge every share, and the option to cash out the moment a resale statement clears. So in other words, they sell the shares first, ask questions never, and the retail crowd wakes up wondering why the price graph looks like a ski slope. So this is the key point. The September 15th crash was not a mysterious market mood swing. It was the predictable result of 500 million discounted shares stampeding through an order book designed for a few million. Supply floods, the price sinks, and the physics lesson is complete. Now that we know the pipe funds just hurled 500 million shares at the market, let's talk about the people who actually built the company and why they could only watch from the sideline. So start with the clock. When the merger closed on August 14th, 2025, every founder, director, and early employee signed a two-tier lockup. Tier 1 was that 50% of their stock sits behind a 90-day fence. The gate opens around November 12th, just to let you know. Tier 2, the other half stays locked for a full 180 days, so February 11th, 2026, just to let you know. So the total insider stash, including founders and key executives, is only about 22 million shares, roughly 6% of the outstanding share count. Compared with the 500 plus million pipe shares now roaming free, that is a water pistol next to a fire hose. So in other words, Monday's landslide had nothing to do with the insiders cashing out. Their shares are still in the penalty box. But the people who got access to the pipe, well, there you go. So why does this schedule matter? Because it sets a second and third supply checkpoint. In mid-November, a modest 11 million share drip hits the tape. So if the stock is still on life support by then, even that small trickle can feel like a sandbag on a drowning swimmer. And then in mid-February is the remaining 11 million unlock. By then, we will probably know whether the market digested the pipe flood or if it's still chewing on it. And remember, the insiders usually want higher prices at the end of the day because they need that equity for future raises, collateral, and bragging rights at cocktail parties, so they're somewhat motivated to keep the dilution under control. But unfortunately, motivation does not erase math. If the Yorkville convertible resets to $2 and the shelf gets tapped for more cash, those insider stakes shrink in percentage terms regardless of their good intentions. So the key takeaway is that the early team is still handcuffed. Their unlock waves are smaller and later, but they can still add slippery stones to an already greased slope. So keep these dates on your calendars, kids. And then this is the convertible note, the financial Swiss Army knife that can morph into shares whenever the holder whistles. On August 15th, NAKA borrowed $200 million from Yorkville at a headline conversion price of $2.80, which sounds benign until you read the fine print. There is a reset clause. The note gets one shot at a makeover. On the trading day before the S3 resale statement goes effective, the Yorkville looks at the volume-weighted average price and multiplies it by 1.3. If that math spits out anything below $2, the floor kicks in at $2 flat. So if the stock is sinking in the low ones when the SEC stamp arrives, Yorkville converts at the floor and suddenly holds up to 100 million shares, which is 200 million divided by $2. And then you gotta talk about collateral. Within 10 business days of closing, NAKA must park at least 400 million Bitcoin inside escrow, which is the collateral that backs the convertible note. Which is a great headline for a Bitcoin treasury strategy, sure, but also a reminder that Yorkville owns the key if things get ugly. And then there is another immediate sell window. Once those shares land in Yorkville's account, they can sell them into the open market the same day. So that means every new low price creates an incentive loop. The lower we trade, the cheaper Yorkville can reset. The more shares they unlock, the bigger the selling fire hose. There is no coupon, but plenty of dilution. The note skips a hefty interest rate. Instead, it serves dilution for breakfast, kids. So essentially, the shareholders are paying Yorkville with slices of the cap table rather than cash. So the net effect is a loaded spring sitting under the share price. If the S3 becomes effective while we sit below $2, 100 million fresh shares can appear overnight. That number would grow the float while the pipe flood is still draining. So this is not financial advice, never is. Remember, it's financial entertainment. I just gotta say, watch the S3 effectiveness date like a hawk, track the volume-weighted average price, and remember that the convertible floor is a price magnet, not a safety net. And remember, NASDAQ switched on listed contracts on September 11th. And the speculators have arrived with sledgehammers the very next day. Market Beat flagged about 38,000 call contracts. That is the right to buy roughly 3.8 million shares, trading hands before most folks finish their morning coffee. Now, this is how it could turbocharge a sell-off. Number one, the dealers sell calls, then neutralize the risk by shorting the stock. So every fresh call a market maker writes forces them to borrow common shares and hit the bid so their net position stays flat. More calls, more shorting, simple algebra. And then the gamma pressure turns drops into cliff dives. As the price falls, the delta on those calls shrinks so dealers can buy back some of their hedge, but the volume printed during Monday's unlock overwhelmed any relief rally. So picture a hydraulic press that lets off steam only after it has already crushed the object inside. And then speculators can copy and paste that trade. They can watch the price skid. Momentum traders can load up on puts or sell even more calls, which prompts dealers to short more stock. This self-reinforcing loop acts like throwing gasoline on a bonfire that was already roaring from the pipe flood. So I'm just saying maybe the options listing had some effect here. Maybe it has turned gravity into terminal velocity. Maybe, I'm just saying maybe, but I've seen whenever a stock gets stock options, sometimes the volatility dial goes from high to ludicrous. So time to square the circle between the orange pill headline and the bloody share count. So number one is the dream. Management raised 510 to 540 million from the pipe, plus the 200 million from the Yorkville note, plus the pre-merger cash, to build a pretty solid Bitcoin treasury at 5,744 BTC. And if you remember, they kicked it off with a cute Twitter-worthy stunt, a ceremonial 21 BTC buy, then a cannon blast 5,744, which was a $679 million swipe that screamed, "We mean it." Now, before the faceplant that we just had, the stock was trading at a nice premium, meaning that you were paying a nice percentage premium for the same sat stack, but that premium has now vanished the moment the pipe shares have hit the tape. And remember the dilution drag, kids. That's kind of the name of the game. We need to ensure that future dilution is accretive to the shareholders. So unless the company keeps stacking coins faster than it prints shares, the per share exposure will keep slipping. So now we're just going through kind of some necessary growing pains in a Bitcoin treasury strategy. Not everybody has to do pipe, of course, but that said, the early bulls care about the number of coins, but now they must track the coins per share, a very different sport. The market's telling the management now, great treasury idea, now let's see some execution. I know that the shareholders probably don't like looking at the price action, but this is a long-term investing game. Unless you want to trade this volatility, then go ahead, be my guest. Remember, we've seen Bitcoin on the balance sheet be rocket fuel for lots of companies, but only if the cap table leak is sealed. Otherwise, the valuation game can become a bit of a mess. So as we wind down here, remember that there's an insider 90-day unlock around November 12th, which, is about 11 million shares, which could be enough to nudge a fragile price chart. The founders will either hodl to prove conviction or maybe trim a sliver to pay their taxes. And remember, there's also an ATM shelf that's live 24/7. Management now has a $5 billion universal shelf. Any surge in price, even intraday, that could trigger an at-the-market equity drip, which could add shares to the supply to buy more Bitcoin, which could be accretive to the shareholders. Or it could not be, but I do not think they'd use the facility at that moment in time. So I think that right now we're just keeping our eyes on the next BTC purchase, timing unknown. More coins could fix some sentiment right now, but only if funded without dumping more fresh stock, of course. I think right now, if they finance with existing cash or debt, the market might cheer a little bit more, but if they sell equity right now, we're back on the dilution treadmill, which would not go over well. The headline may say stacked, but investors will zoom straight to coins per share math. So time to land this plane. Here's some easy lessons for you guys to tattoo on the inside of your eyelids. Number one, the supply just beats sentiment every time. A 40+ fold jump in tradable shares is not a vibe shift. It is gravity with a calculator. The price is going to drop not because people hate the story, but because the order book cannot swallow that many certificates. Remember, Yorkville can still conjure 100 million shares out of thin air. And remember, the unlocking is going to come in waves. The pipe flood today, partial insider unlock in November, the second insider unlock in February. The calendar decides when the next selling pressure arrives, not some mood swing on Twitter. Now, in my humble opinion, what matters now to the shareholders needs to be an increase in Bitcoin exposure. The Band-Aid has been ripped off. Now it's time for the team to execute. But remember, I think volatility will be here to stay. We got options now. We got an always-on ATM shelf, a live convertible. So I think the traders are going to love the stock, but the long-term holders of Nakamoto are going to need some Dramamine, which is fine, for those that can handle it, of course. So really, over the past few months, Nakamoto has been a real-time case study in capital structure physics. Remember, kids, if you're going to invest in these things, you need to master the math and respect the calendar. Never confuse a Bitcoin headline with the dilution reality. So best of luck out there. If you're holding this long term, I hope you're not too beat up over this thing. But of course, long term could mean 3 months for some and 6 years or 20 years for others. I hope you enjoyed this content. My name is Adam Livingston. I am the Bitcoin Wizard. By the way, if I got anything wrong in this presentation, let me know. I tried to quadruple check my fact checking, so hopefully it was fine. But I thank you guys for listening. If you enjoyed the content, please like this video, subscribe to the channel, and have a terrific day. Class dismissed.